Apple's on the cusp of another milestone. The tech giant could soon be worth $3 trillion, just over a year after breaching the $2 trillion mark. With a market cap like that, if Apple were a country, it would be as big as the world's fifth largest economy after Germany. Martin Yang is a senior analyst in equity research for Oppenheimer & Co.
In a way, it's shocking to see it as large as a country, but in another way, it's a natural result of a company that are producing a piece of must-have consumer hardware that also happens to be the highest in quality.
Apple stock has jumped about 30% this year on top of an 80% surge in 2020, powered by investors betting on its brand and viewing it as a comparative safe haven. Apple hit $1 trillion in market capitalization in 2018. It took 2 years to double that valuation. To hit the new milestone of $3 trillion, Apple will need to trade above $182.85. They finished Thursday shy of that, around $174 a share.
A majority of economists in a recent poll predict the Federal Reserve will start to raise interest rates in the third quarter of next year, and some believe the rate hikes could begin even sooner. That's a big change from just a month ago when some economists feared the Fed was going to move too slow. According to the Reuters poll released Thursday that was conducted between December 3rd and 8th, the shift in expectations is due primarily to stubbornly high inflation, something Fed Chairman Jerome Powell took notice of in his recent testimony before Congress.
Price increases have spread much more broadly in the recent few months across the economy, and I think the risk of higher inflation has increased.
To counter that, economists predict the Fed will gradually raise rates by 25 basis points in the third quarter of next year, followed by 3 more hikes, one in the fourth quarter of 2022, and then 2 more in the first half of 2023, bringing the Fed's key interest rate from near zero to 1.25% to 1.5% by the end of that year. But the poll also suggests the pace of those rate hikes could be altered if any resurgence in the health crisis slows the economy enough to threaten the recovery. That isn't the case for now. New data released Thursday showed new applications for jobless benefits dropped to just 184,000 last week. Not only is that the lowest since millions were forced out of work nearly 2 years ago at the start of the health crisis, but it's the lowest in more than 52 years. New clues on Fed thinking will be released next week after policymakers hold their final 2-day meeting of the year.
Hugs and cheers Thursday after Starbucks workers voted in favor of a union at one company-owned Starbucks store in Buffalo, New York, in a first for the coffee giant in the U.S. The store in upstate New York voted to join Workers United, an affiliate of the Service Employees International Union. Workers at a second location in Buffalo voted to reject the drive to organize. The vote at a third store ended without a definitive result because a number of ballots were still under review. The closely watched results come as corporate America eyes new union organizing campaigns amid a U.S. labor shortage that has already led to higher wages at most large retailer and restaurant chains. Though financial analyst Art Hogan told Reuters on Thursday the path toward unionization at Starbucks won't be easy.
Is this going to tip over the apple cart for them, or is this the beginning of something where employees say, how well am I treated at Starbucks? And when you step back and look at the way Starbucks actually treats their employees, both being one of the first companies to raise the minimum wage for employees, paying for education, and the fact that they've kept their employees safe by shutting down stores during the pandemic, I think that it's one of those cases you'd be hard pressed to say a union is going to have a very easy road into all of these stores.
Some local baristas had decried what they said were aggressive company tactics, including flooding Buffalo locations with executives, holding meetings with employees, and even bringing in ex-CEO Howard Schultz to talk to workers and extol the virtues of existing wage hikes and benefits. Starbucks denies that any of its actions amounted to union busting. The vote was 19-8 in favor of joining the union.
The U.S. labor market is tightening further amid the worker shortage. The Labor Department reported Thursday the number of Americans filing new unemployment claims dropped to its lowest level in more than half a century. Weekly jobless claims tumbled to 184,000 last week. much more than economists had forecast. That's a steep plunge from the record high of over 6 million filed in early April of 2020. Normally, claims increase with the onset of colder weather. But due to a tightening labor market, economists foresee a break with that seasonal pattern. Consider this. 11 million jobs were unfilled at the end of October. That's why employers are reluctant to let go of workers. The unemployment rate fell to a 21-month low in November. The latest report suggests the economy is regaining steam, but the spread of the Omicron variant poses a risk to that outlook. Goldman Sachs has cut its forecast for U.S. economic growth to 3.8% next year from greater than 4%, citing uncertainty stemming from Omicron. Investors booked some profits Thursday after 3 straight days of gains, sending stocks on Wall Street lower. They looked past a report showing weekly jobless claims plunging to a 52-year low. National Securities Chief Market Strategist Art Hogan says Wall Street and the Federal Reserve are focused on inflation, anxious over the consumer price data that comes out Friday and the Federal Reserve's policy meeting next week.
This is a day where we thought we'd probably celebrate a terrific jobless claims number, but we may have already celebrated that over the last 3 days. So today's that day where most investors are saying, you know what, it's probably okay to take a pause here. Let's see how CPI comes out tomorrow morning. And let's see how that makes us think about what the Fed has to say on Wednesday.
The Dow shed more than 150 points. The S&P 500 retreated 1/5%, and the Nasdaq dipped 0.1%. Shares of Amazon fell. Italy slapped the e-commerce giant with a $1.3 billion fine for alleged abuse of its market dominance. CVS Health rose. The drugstore operator hiked its full-year profit outlook. Administering COVID-19 vaccinations and diagnostic testing significantly boosted its quarterly operating profit. Shares of the poster boy for meme stocks, GameStop, fell. The video game retailer said the U.S. Securities and Exchanges Commission issued a subpoena in August for documents on an investigation into its share trading activity. The company also reported a quarterly loss that was more than double what analysts expected. Starbucks declined. Workers voted to join a union at one store in Buffalo, New York, but rejected the union at a second location in the city.